Today we're diving into an investment report that argues NVIDIA's dominance is locked in for 2026, thanks to its Blackwell architecture and just sheer financial momentum.
Yeah, and this is a really strong piece of analysis. You can feel the conviction, the deep knowledge. It's got a great core thesis. NVIDIA is still the king of Wall Street.
It's a bold claim.
It is. And to make a claim like that totally bulletproof, we need to stress test the foundations. So I think a more robust investment analysis here requires the moat section to preemptively address and really dismantle the toughest counter-arguments to the CUDA ecosystem.
Okay, so let's start there. The moat. The report makes a big deal about the CUDA is sticky argument. It basically says competitors like AMD or Intel just can't catch up because everyone's locked into NVIDIA's software. Rewriting all that code is just too expensive, too risky.
And that's true. I mean, historically, that's been the whole game. CUDA stickiness is absolutely the key factor. I just wonder if we're fully anticipating how a real disruptive attack might not meet it head on, but try to go around it.
Go around it? What are we missing?
Well, the weakness, I think, is that the report dismisses competitors pretty quickly. It doesn't really engage with the specific, maybe high-risk scenarios where that CUDA moat could actually start to erode.
Right.
For an analysis that's calling for, 300-plus targets, that implies massive, sustained growth. You have to anticipate the worst case, but still plausible, risks.
That's a fair point. If you're that bullish, you have to show you've considered what could go wrong and have an answer for why it won't.
Exactly. You need to consider game-changing disruptions. Like, what if there's a huge industry shift to open-source AI frameworks that just abstract away the hardware?
Making the chip underneath almost irrelevant.
Almost. Or, and this is maybe even more critical, what if one of the big hyperscalers gets serious about their own custom chips, their ASICs, not just as a side project, but at a scale that really challenges NVIDIA's core volume?
I see what you're getting at.
The analysis needs to treat these not as, footnotes, but as real threats that have to be defeated on paper first.
So the current defense feels a bit passive. It just relies on how hard it is to switch. You're saying it needs a more active defense.
Yes, one that takes on specific invasion vectors.
But is it an efficient use of space? I mean, if NVIDIA is so far ahead, why spend so much time on competitor hypotheticals?
Because for a high-conviction report, it's absolutely essential. So the suggestion is to reframe the whole moat section, explicitly forecast the competitive landscape through these specific high-impact scenarios.
Okay.
And then you provide the compelling data-driven counter-evidence for why NVIDIA is secure against those specific threats. It should feel like the author actively tried to break the moat and failed.
So less of a general statement and more of a quantified risk assessment.
Precisely. Don't just say CUDA is sticky. Analyze the actual monetary and time cost of switching.
Okay, give me an example.
Let's say quantify the switching cost. Contrast the, millions of lines of developer code a company has versus the theoretical performance gains from a competitor's chip.
Let's use a concrete example, like agentic AI. A big global bank is moving into AI that can make its own decisions. They're locking their entire business process into that tech stack.
Perfect example. Use that. What's the cost of rewriting their entire AI operational layer? It's millions, maybe billions in cost and risk. Contrast that with, say, a theoretical 10 or 15% better performance from some new chip.
The risk-reward calculation just doesn't add up for the bank.
It overwhelmingly favors NVIDIA. And when you quantify it like that, you demonstrate the moat isn't just a general concept, it's engineered against specific breaches. That's the depth you need to justify a King of Wall Street thesis.
That makes sense. It strengthens the whole foundation. Okay, let's shift to the financial argument, which is another clear strength here. The numbers are incredible.
They really are.
Forecast Q3 26 revenue of $57 billion, Q4 at $65 billion, gross margins over 73%, and free cash flow around $22 billion a quarter.
The velocity is just breathtaking. I mean, it's the definition of an exponential curve. But to really elevate that bull case, that 300-plus number, the analysis needs a much more explicit, quantitative bridge between that velocity and the valuation model itself.
So what's the missing link? You have this massive river of cash, but how does that translate to that specific high-end price target?
Well, the weakness is that the analysis presents this tsunami of data, and then it attributes the price target to more general ideas.
Like sentiment.
Right. Sentiment and sovereign AI adoption. And those matter, of course they do, but the specific financial mechanics, especially this huge shift to selling AI factories.
You mean the NVL 72 racks?
Exactly, the racks of 72 GPUs. That's the engine of growth, but it's currently implied. It's not demonstrated as a justification for the valuation. We see the big numbers, but not the specific path to get the stock price there.
So the engine is there, but the map to the destination isn't drawn clearly.
That's a great way to put it. So the suggestion is to quantify the impact of what the report calls the unit economy.
Okay,
This is a critical concept. NVIDIA isn't just selling chips anymore. They're selling infrastructure as a product. So use the physical sales unit, the NVL72 rack, and build a clear scaling model that justifies the revenue trajectory for that $300 valuation.
that makes it more concrete. It shifts from macro trends to measurable micro conversions.
Exactly.
But here's a question. Doesn't building a model around a single unit, the NVL72, risk being too granular? You might lose the macro investors who just want the big picture.
That's a valid concern, and the answer is balance. But if the whole point is that NVIDIA is the king of Wall Street, we have to show why the valuation is structurally sound, not just hype.
And that means showing the math.
It means showing how many of these high-margin AI factories the market must absorb to hit the free cash flow and PE multiples needed for a $300 stock price. It just removes the ambiguity of sentiment.
You're grounding the trajectory in physical sales, in customer adoption, not just market excitement.
And to build on that, we need specific examples. Create a simple model. Let's say the analysis assumes X thousand NVL72 units have to be sold outside the usual hyperscaler business to hit that target.
Right.
Okay, so how many sovereign AI nations or major enterprises need to adopt this infrastructure in 2026 to get to that number?
Well, the report itself mentions Japan and the UAE as key adopters of sovereign AI.
Perfect. Use them. Quantify the expected sales volume to those specific nations. Then you can show the specific conversion rate from one NVL72 unit sale to the overall revenue target.
And the bull case suddenly becomes a lot less about a general trend and much more about hitting specific, demonstrable sales figures.
Exactly. You're moving the valuation from a qualitative assessment of excitement to a quantitative model of capacity and conversion. That's a huge step toward making the case airtight.
That's really powerful. It links the physical product to the future stock price. So, for our last point, let's look at how the growth drivers connect. The report does a great job introducing the Blackwell supercycle in Section 1, and then later, in Section 4, it talks about this massive new customer base, sovereign AI and enterprise agentic AI.
Yeah, both sections are critical, but I think the relationship structurally could be a lot tighter. The narrative and the impact would be maximized if you structurally integrated those new demand segments directly into the discussion of the Blackwell supercycle itself.
Okay, so the argument is that the report's main thesis, that NVIDIA is becoming foundational infrastructure, not just a chip maker, really depends on these new customers, but they feel a bit siloed off.
That's the weakness, exactly. The current structure treats Blackwell's dominance, which is mostly framed through the lens of hyperscaler needs, as one thing.
And the new customers, sovereign AI and enterprise, as another separate thing.
Right. And for a shift this massive, where NVIDIA's whole identity is changing, these new segments can't be just a new market opportunity. They have to be presented as the immediate, inevitable result of the technology leap. Right now, they feel like an addendum, not the central proof point.
So the suggestion is to weave them into the tech argument much earlier. But if you do that, do you risk diluting the focus on the hyperscalers? They're still the main revenue drivers, for now.
You don't dilute it. You clarify it. You clarify the ultimate beneficiaries. The suggestion is to restructure the Blackwell supercycle discussion to frame the architecture as a solution to three distinct massive problems at once.
3 problems?
First, yes, the hyperscalers' need for efficiency. Second, the nation's demand for secure domestic infrastructure, sovereign AI. And third, the global enterprise's need for high-volume, cost-effective inference for agentic AI.
So by showing the technology solves all 3 problems at the same time, the case for its ubiquity and NVIDIA's dominance gets much stronger. It immediately answers the so what for the new customers.
Exactly.
What's a concrete way to do that, to show that integration?
Let's go back to that key technical metric from the report. Blackwell's massive leap in efficiency. It's up to 25x lower cost and energy consumption.
Right.
Right now, that's mostly applied to hyperscalers training bigger models. Instead, you explicitly state how this performance leap unlocks the potential for these new market segments.
Okay, so how is that 25x efficiency an enabler? Give me an example.
For sovereign AI, explain how that 25x efficiency is the foundational requirement that lets these nations build cost-effective domestic clouds. Without it, the initial cost and the ongoing energy bills would be prohibitive.
So before Blackwell, building their own AI capability just wasn't economically feasible for a lot of countries.
Correct. Blackwell makes it feasible. And by explaining it that way, you directly link the tech in Section 1 to the multi-billion-dollar revenue stream in Section 4. It's not just an improvement for old customers, it's the specific architectural shift that creates the new market.
That makes the narrative feel like one seamless, inevitable story, driven by the product itself, that really elevates the analysis.
Look, this is already high-quality work,